Welcome to our deep dive. We're going to be looking into some value stocks today.
Value stocks.
Yeah, those companies that seem like they're on sale,
Right.
but are they actually a bargain or are they masking some bigger problem?
Yeah, that's the big question.
And that's exactly what we're going to try to figure out today.
Absolutely.
We're going to be using an article by Jabin Bastian. It was published March 4th, 2025.
Okay.
It's called Three Value Stocks Facing Fundamental Challenges.
All right.
So we'll be unpacking three specific companies: Amkor, American Airlines, and CVS Health,
Interesting.
to see if those low prices are a steal or a warning sign.
A low price isn't always a good thing.
You're right.
It's like seeing a flashy car for sale for a ridiculously low price. Your first thought should be, what's wrong with it?
Yeah, exactly. What's the catch?
It's the same with stocks. We need to look under the hood and understand the why behind that discount.
Okay, so let's pop the hood on our first company. Amkor, ticker symbol AMKR.
Okay.
They're in the semiconductor business, but they're not actually making the chips themselves. They package and test them mostly over in Asia.
Okay, interesting.
Now, at first glance, their forward price to earnings ratio, or PE ratio, of 10x seems pretty tempting.
It does, yeah.
It means that for every $10 you invest, you're theoretically getting $1 of earnings.
Right.
But the analysts in the article, they weren't so convinced. They used terms like plummeting sales and meager cash generation, which caught my eye.
Yeah. Plummeting sales doesn't exactly scream, buy me.
No, it doesn't. So what's the financial picture actually telling us here?
Well, their revenue has been declining by 5.6% annually over the last 2 years.
Okay.
And projected sales for the next 12 months are basically flat.
Hmm.
This lack of growth could indicate weak demand.
Yeah.
Additionally, their gross margin, which is the profit they make after deducting the cost of goods sold,
Right.
is a rather low 14.6%.
Oh.
This is likely due to intense competition and production costs.
Okay, so are we already seeing signs of a value trap here?
Well, not necessarily.
Yeah.
It's not a clear-cut case. They do have a strong balance sheet with a net cash position,
Meaning?
meaning they have more cash on hand than debt.
Oh, that's good.
And if we look back over the past 5 years, they've actually had decent sales growth.
Okay.
So there are some positives mixed in with the negatives.
Yeah, some mixed signals for sure. What about their recent performance?
Mhm.
Did their last earnings report give us any more insight?
Their latest earnings report was interesting. They beat earnings per share, or EPS estimates,
Meaning?
meaning they earned more profit per share than analysts were expecting.
Okay, that's good.
However, they missed revenue guidance,
Oh.
meaning their overall sales fell short of projections.
So it's not all sunshine and rainbows.
Right. It's a bit of a mixed bag.
They're giving us some mixed messages there. Now, here's a detail I found particularly interesting. Their days inventory outstanding, or DIO, is actually 10 days below its 5-year average.
DIO.
Yeah, it's a measure of how long it takes a company to sell its inventory.
Oh, okay.
Now, wouldn't a lower DIO usually be a good sign?
You would think so, yes?
Yeah. It would suggest that their products are in high demand.
Typically, yes.
Mhm.
But we need to be careful about jumping to conclusions.
Okay.
In this case, it might actually indicate that demand is softening, and they're working through existing inventory more quickly to avoid a buildup.
Interesting. So it could be a good thing or a bad thing.
It's definitely something you'd want to investigate further.
For sure. So how do we reconcile this with the fact that analysts have set a price target for Amkor significantly higher than its current price?
Right.
I mean, that suggests they see potential for growth, right?
It seems like even the experts are struggling to interpret these conflicting signals.
Yeah, it's a real head-scratcher.
And that's precisely why we need to dig deeper than just the PE ratio to truly understand the investment potential.
Couldn't agree more.
Right.
All right, let's switch gears and fly over to our next company, American Airlines, ticker symbol AAL.
American Airlines.
Yeah, one of the big 4 airlines. They fly passengers all over the world.
Huge company.
But with a forward PE ratio of 5.8x, is this a sign that they're ready for takeoff or headed for a nosedive?
Well, that low PE ratio might make it seem like a steal.
Right.
But the article raises some serious concerns. Analysts point to weak sales growth and negative returns on capital.
Negative returns on capital. What does that even mean?
It means they're not generating much profit from the money they've invested in the business.
Oh,
Not really a recipe for success.
not at all. So let's break down their financials and try to understand what's driving those concerns.
Okay, so over the past 5 years, their revenue has grown at a pretty sluggish rate of 3.4% annually.
Okay.
And their earnings per share, or EPS, has actually declined by an alarming 17.5% annually over the same period.
Yikes.
And to make matters worse, they're carrying a mountain of debt. Their net debt to EBITDA ratio is a whopping 6x.
6 times.
EBITDA stands for earnings before
Hmm.
interest, taxes, depreciation, and amortization.
Right.
This ratio tells us how many years it would take for them to pay off their debt if their earnings stayed constant.
Okay, so 6 years to pay off their debt if things stay the same.
Exactly.
That's a lot of debt. That's a pretty big red flag for me.
It's definitely something to consider.
But haven't there been some positive news about American Airlines lately?
Hmm.
I thought they beat earnings estimates recently.
You're right. Their most recent earnings report did beat both revenue and EPS estimates.
Okay, so that's good, right?
It is a positive sign. And their revenue passenger miles, a key metric for airlines,
All right.
also exceeded expectations.
So are we seeing a turnaround here?
Well, it's too early to tell.
Okay.
While those recent performance indicators are encouraging, they also missed their full-year EPS guidance, meaning they're not expecting to earn as much profit for the entire year as they initially projected.
Oh, I see. So they're kind of giving us mixed signals again.
It seems to be a theme today.
It does, doesn't it?
Yeah.
But here's a detail I found really perplexing. Despite all these challenges, Wall Street analysts are predicting a 26.9% EPS growth for American Airlines over the next 12 months.
26.9%.
That's what they're saying. What could they possibly be seeing that we're missing?
That's the million-dollar question. It seems like they're anticipating a surge in travel demand,
Okay.
perhaps driven by pent-up travel desires post-pandemic. Or maybe they're banking on some significant cost-cutting measures that will boost their bottom line.
Interesting. It's definitely something we need to investigate further.
Agreed. These deep dives are always so fascinating. There's always more than meets the eye.
That's for sure. All right, speaking of seemingly good bargains, let's move on to our final company for today. CVS Health, ticker symbol CVS.
CVS. They're not just your corner drugstore anymore, are they?
Not quite. They've evolved into a much more complex and diverse business model.
No way.
Well, besides their retail pharmacies, they own Aetna, a major health insurance company.
Oh, wow.
And they also have a pharmacy benefits management arm, CVS Caremark,
I didn't know that.
which negotiates drug prices for insurers and employers.
So they've got their fingers in a lot of pies. They do.
But with a forward PE ratio of 11x, are investors getting a sweet deal or a bitter pill?
Well, that's where things get interesting.
How so?
The analysts in the article expressed some skepticism about CVS Health's profitability
Only.
and questioned whether they have exciting growth opportunities in the future.
So what are they concerned about specifically?
Over the past 5 years, their adjusted operating margin and free cash flow margin have been on a downward trend.
And that's bad because...
These margins are crucial indicators of a company's profitability and financial health. Additionally, their earnings per share, or EPS, has fallen by 5.2% annually over the same period.
Not good.
And similar to American Airlines, they're carrying a substantial amount of debt.
So debt seems to be a recurring theme today.
It's definitely a pattern we're seeing.
It's a bit concerning to see these seemingly value companies burdened with such heavy debt loads.
It's something to keep an eye on for sure.
But what about their recent performance? Have they been able to buck the trend at all?
Their last earnings report was a mixed bag. They did manage to beat both revenue and EPS estimates,
Okay, so that's good.
which is positive. And their same-store sales growth, which measures sales at stores that have been open for at least a year,
Right.
was quite impressive.
Wow.
However, they also missed their full-year EPS guidance.
So that familiar pattern again.
Exactly.
It's like they're playing a game of financial tug-of-war, and we're trying to figure out which side is winning.
A very apt analogy.
Now, there's one detail about CVS that I found particularly striking. Their return on invested capital, or ROIC, has been steadily decreasing.
ROAC.
Yeah, it's a key metric that tells us how effectively a company is using its capital to generate profits.
Right.
So does this declining ROIC signal a worrying trend for long-term investors?
That's a great observation. A declining ROIC is often a warning sign.
In what way?
It means that the company is becoming less efficient at generating returns on the money it invests in its operations.
Oh, I see.
This could signal trouble ahead for long-term investors if this trend continues.
So maybe not such a bargain after all.
It seems like with these value stocks, the devil really is in the details.
Absolutely. It's a good reminder that we can't just rely on those headline numbers like the PE ratio.
Exactly.
We need to dig deeper, understand the context, and analyze the company's overall financial health before making any investment decisions.
I couldn't agree more.
And that's what we're going to continue doing in part 2 of our deep dive. We'll delve even further into these companies, looking beyond the numbers and examining their competitive landscapes, their management teams, and any other factors that could shed light on their true value. So be sure to join us for the next part of this fascinating exploration of value stocks.
I'll be here.
Welcome back to our deep dive into the world of value stocks. Remember, we're not just looking at whether a stock is cheap, but trying to understand why it's cheap. We've already uncovered some fascinating details about Amkor, American Airlines, and CVS Health. They each have tempting PE ratios, but we've also seen some underlying financial concerns that we can't ignore.
Exactly. It's like buying a house just because it has a low price tag. You'd want to know why it's so cheap, right? Are there structural problems? Is it in a bad neighborhood? The same applies to stocks. We need to go beyond those surface level numbers and dig deeper to uncover the full story.
Okay, let's pick up where we left off with Amcor. We were discussing their days inventory outstanding, or DIO, being lower than its 5-year average. What else should we consider when evaluating this company?
Well, we need to look beyond just Amkor and zoom out to the bigger picture of the semiconductor industry. This industry is known for its cyclical nature. There are periods of booming growth followed by downturns. So Amkor's recent struggles with declining sales could be partly due to a cyclical downturn in the semiconductor market rather than some inherent problem with the company itself.
That's a great point. So how do we determine if this is just a temporary blip or a sign of a more serious problem?
We need to assess their position within the industry. Think of it like evaluating a basketball player. You wouldn't just look at their points per game in one season. You'd want to know their field goal percentage, their assists, their rebounds, all those other factors that give you a more complete picture of their performance. Similarly with Amkor, we need to look at factors like their market share, their relationships with key customers, and their ability to innovate and adapt to changing industry trends.
So are they the LeBron James of semiconductor packaging, or are they riding the bench? What's the competitive landscape like?
It's a tough industry. The article mentions some serious competitors like ASE Technology, PowerTech Technology, and Silicaware Technology. They all offer similar packaging and testing services, so Amkor isn't playing solo in this game.
Okay, so it's a crowded field. What sets Amcor apart? Do they have any slam dunk advantages?
One potential advantage is their global reach. They have facilities in multiple countries, which could be an advantage when serving international customers.
That makes sense. Having a global footprint could give them access to a wider range of customers and potentially make them more resilient to regional economic downturns. But wouldn't a global operation also introduce complexity and potential risks? Think about supply chain disruptions or political instability in different regions.
You bring up a valid point. There are definitely trade-offs.
Yeah.
Managing a global operation is no easy feat. But Amcor's experience in this arena could be a valuable asset, allowing them to navigate those complexities more effectively than a newer, less established player.
And we can't forget their strong balance sheet. Their net cash position gives them some flexibility to weather those storms and potentially invest in growth opportunities. It's like having a financial cushion to fall back on.
Absolutely. That financial stability is not to be underestimated. But remember, even with the best financial resources, a company's success hinges on its ability to execute its strategy effectively and adapt to a constantly changing market.
Right. Amcor seems to be a bit of a mixed bag. They have some attractive qualities, but those financial red flags and the competitive intensity of the semiconductor industry are definitely factors to consider carefully.
I agree. It's not a simple buy or sell decision. It requires a deeper dive looking at those nuances and weighing the potential rewards against the potential risks.
All right, let's fasten our seatbelts and shift our focus to American Airlines. We talked about their heavy debt load and weak sales growth. What else should we consider when analyzing this company?
Well, we need to remember that the airline industry is notoriously volatile. It's like a roller coaster ride, lots of ups and downs. Fuel prices, economic conditions, global events, they all impact an airline's profitability.
Yeah, it's like they're constantly flying through turbulence. And with the recent pandemic, the rise in oil prices, and all the geopolitical uncertainty in the world, it seems like the turbulence has been especially intense for airlines lately.
Exactly. And American Airlines, being one of the largest airlines globally with extensive international operations, is particularly exposed to these external factors.
So how well are they handling those challenges? Are they just trying to ride out the storm, or are they taking proactive steps to make their business more resilient?
While their recent earnings beat and exceeding revenue passenger mile expectations suggest they are adjusting to the current environment. But their overall financial health requires further investigation. One area to consider is their cost structure. Are they actively trying to become more efficient and reduce expenses?
That's a crucial question. If they can trim the fat and operate more leanly, they might be able to improve their profitability even when external factors are working against them. Does the article provide any insights into their cost-cutting efforts?
It doesn't delve too deeply into that aspect. It does mention an expectation of operating margin improvement in the coming year. But remember, we need to be cautious about relying solely on projections.
That's true. Projections are just educated guesses about the future. And the future can be very unpredictable, especially in a volatile industry like airlines. But speaking of future uncertainty, their massive debt burden is a major concern. How are they planning to address that?
That's a big question mark. The article doesn't offer any specifics on their debt reduction strategy. This is definitely something investors will be watching closely. How they plan to tackle this issue will significantly influence their long-term prospects. It's like a heavy suitcase they're carrying around.
Yeah.
It's going to weigh them down and make it harder for them to move forward. Exactly. And that debt is not just a burden for the company, it's a risk for investors as well. It limits their flexibility and makes them more vulnerable to economic shocks. It's like flying with only one engine. You might be able to stay in the air for a while, but it's a lot riskier. You hit the nail on the head. It's a classic high-risk, high-reward situation. They have the potential to soar if they can manage their debt and capitalize on the travel rebound. But there's also a real possibility of a nosedive if things go wrong. Investors need to carefully weigh those factors and decide if they're comfortable with that level of uncertainty.
Now let's switch gears to our final company, CVS Health. We talked about their declining margins and their entry into the health insurance market with the acquisition of Aetna. What other things should we be thinking about when evaluating this company?
The regulatory environment is a crucial aspect when considering healthcare companies. It's a heavily regulated industry, and changes in regulations can significantly impact CVS Health's profitability.
So it's not just about understanding their business model, it's about understanding the rules of the game. Are they skilled players in this regulatory arena? Can they adapt and thrive even when the rules change?
That's a key question. The healthcare landscape is constantly evolving, with new laws, regulations, and reimbursement policies being implemented. CVS needs to demonstrate its agility and adaptability to succeed in this dynamic environment.
And they're not the only ones vying for success in this arena. They're facing competition from other giants like Walgreens, Boots Alliance, United Health Group, and Cigna. It's like a battle of the titans.
You're absolutely right. The healthcare market is fiercely competitive, with multiple players vying for market share and dominance. So it's essential to assess CVS's strengths and weaknesses in this competitive landscape.
Okay, so what are their strengths? What makes them stand out in this crowded field?
One of their key strengths is their sheer size and scale. They have a vast network of retail pharmacies, a massive customer base, and significant bargaining power with suppliers. It's like being the biggest kid on the playground. You have a certain advantage just because of your size.
That makes sense. Their size gives them leverage in negotiating prices, securing favorable contracts, and potentially weathering economic storms better than smaller players. And their diversified business model, combining retail pharmacies, health insurance, and pharmacy benefits management, also seems like a strength. It's like having multiple streams of income. It provides more stability and potential for growth.
You're right, diversification can be a valuable asset. It helps to mitigate risks by spreading them across different business segments. However, it also brings complexity to their operations. Managing multiple businesses effectively can be challenging.
Right, so it's a double-edged sword. And let's not forget about that significant debt load they're carrying. How are they managing that debt and ensuring it doesn't become an albatross around their neck?
That's a crucial question. They need to generate sufficient cash flow to service that debt and avoid financial distress. If they're not careful, that debt could become a drag on their profitability and limit their ability to invest in growth opportunities.
So it seems like CVS Health is a bit of a puzzle. They have some compelling strengths like their size, diversification, and brand recognition. But those concerns about profitability, competition, and debt are definitely worth pondering.
Absolutely. Even seemingly stable, well-established companies like CVS Health can face challenges and unexpected headwinds.
And it reinforces the importance of not getting swayed by surface-level valuations. We need to dig deeper, consider all those nuances, and really try to understand the full picture before making any investment decisions.
Couldn't agree more. That's why we're here to guide you through these complexities, help you understand the different factors at play, and equip you with the knowledge to make informed decisions that align with your investment goals.
Okay, we've examined their financials, their industries, and their competitive landscapes, but there's another crucial element we can't overlook: the management teams.
You're absolutely right. The people at the helm can make or break a company, even with the most solid financials and the best business plan. Poor leadership can lead to disaster. On the other hand, a strong, experienced management team can navigate challenges, capitalize on opportunities, and steer a company toward success.
So in part 3 of our deep dive, we'll shift our focus to those leaders examining the track records, strategies, and overall leadership qualities of the management teams at Amkor, American Airlines, and CVS Health.
It's going to be fascinating to see who's truly flying the plane and whether they have the skills and experience to navigate the turbulence ahead.
Welcome back to our deep dive into value stocks. We've spent the last 2 parts really getting into the nitty-gritty of Amkor, American Airlines, and CVS Health. You're looking at their financials, their industries, the competitive landscapes. But numbers, they only tell part of the story, don't they?
Absolutely. It's like trying to understand a sports team just based on their stats.
Yeah.
You need to know about the coach, the team dynamics, the individual players' strengths and weaknesses to really get a feel for their potential. And in the business world, that's where the management team comes in. That's that crucial human element that can make or break a company.
So in this final part, let's turn our attention to those leaders, the folks calling the shots at these
Yeah.
companies. We'll start with Amcor. What can you tell us about the people at the helm?
Well, unfortunately, the article doesn't give us detailed profiles of Amcor's executives.
Okay.
We can look at their actions and the company's overall direction to get a sense of their leadership style.
Right. So what clues can we gather from their recent performance?
Well, remember how they beat EPS estimates despite missing revenue guidance?
Yeah.
That suggests they're focused on cost control and maximizing profitability, which could be a positive sign. It's like a basketball coach who emphasizes defense even when their offense isn't firing on all cylinders.
Hmm.
Sometimes playing smart and minimizing mistakes can keep you in the game.
That's a great analogy. It shows they're not just sitting back and accepting those declining sales. They're taking action to maintain profitability even in a tough market. But they still need to address those declining sales, right? What's their game plan for turning things around?
Yeah, that's the big question. The article doesn't really provide specifics, but remember they operate in a highly competitive and cyclical industry.
Right.
Their ability to innovate, secure new customers, and adapt to those shifting market dynamics is going to be crucial. It's like being a surfer riding a wave. You need to constantly adjust your position balance and technique to stay on top and avoid wiping out.
So we're looking for signs of agility, strategic thinking, maybe even a bit of fearlessness from this management team.
Right, they can't just sit there.
They need to be able to ride those industry waves and avoid getting crushed.
Exactly. Investors want to see a clear vision and a well-defined plan to navigate the challenges and capitalize on the opportunities in the ever-changing semiconductor market.
For sure. So with Amcor's management, we have a bit of a wait-and-see situation. They've shown some positive signs, but we need more information to really judge their capabilities. Now let's move on to American Airlines. Their CEO, Robert Isom, he's been in the spotlight quite a bit lately. What's his track record like?
Well, he took over as CEO in March 2022, so he's been at the helm for a couple of years now.
Right.
And those haven't exactly been easy years for the airline industry, with the pandemic, rising fuel costs, staffing shortages. It's been a turbulent ride.
Yeah, talk about trial by fire. Has he shown the leadership skills needed to guide the company through these stormy skies?
It's been a mixed bag. They've had some operational hiccups like flight cancellations and delays, which are never a good look for an airline.
Yeah.
But they've also managed to improve their financial performance in recent quarters.
Yeah, okay.
And while that mountain of debt remains a major concern, they have taken some steps to address it, like refinancing some of their obligations to get better interest rates.
So he's shown some resilience, some decisiveness, but there are still some big question marks hanging over his head. What about his overall leadership style? How does he come across to investors?
He's generally perceived as a steady and experienced leader. I mean, he's been with American Airlines for a long time and has a deep understanding of the industry. But some analysts question whether he has the vision and the boldness to make the transformative changes needed for American Airlines to really thrive in the long term. It's one thing to steer a ship through a storm, but it's another thing to chart a new course and explore uncharted waters.
Ah, so it's that classic tension between stability and innovation. Investors want someone who can keep the ship afloat, but also guide it toward new horizons. It's a tricky balance to strike.
Precisely. Investors will be watching closely to see if he can strike that balance and demonstrate the leadership qualities needed to propel American Airlines to a position of strength and sustainable profitability.
Okay, finally, let's talk about CVS Health. Karen Lynch took over as CEO in February 2021. What's her leadership style like, and what direction has she been taking the company in?
Well, her background's interesting. She comes from the insurance side of the business, having previously led Aetna.
Oh, okay.
So her appointment kind of signaled the shift in focus for CVS Health, with a greater emphasis on healthcare services and insurance.
That makes sense given their acquisition of Etna. It's like hiring a chef who specializes in Italian cuisine when you've just added a whole Italian section to your menu. But it's one thing to have the right background, it's another to deliver the goods. So how has the strategy been playing out so far?
It's still relatively early in her tenure, but they've been expanding their healthcare offerings significantly, including primary care clinics and virtual care services.
Okay.
They're really trying to position themselves as a one-stop shop for all your healthcare needs.
Yeah.
From filling prescriptions to seeing a doctor to managing your insurance.
It's an ambitious vision. But as we discussed earlier, they're facing some serious competition from other healthcare giants. It's a crowded playing field with a lot of heavy hitters. How is Karen Lynch responding to that competitive pressure?
She's been quite aggressive in pursuing partnerships and acquisitions. For example, they recently acquired Signify Health, a home healthcare company.
I see.
This acquisition expands their reach into a rapidly growing segment of the healthcare market.
Okay.
She's also focused on leveraging technology to improve efficiency and enhance the customer experience. Think about telehealth platforms, digital prescription management, and personalized health recommendations.
It sounds like she's not afraid to shake things up and make bold moves. But what about their financial performance under her leadership? Have they been able to translate those strategic initiatives into tangible results?
Well, as we discussed earlier, they've been grappling with declining margins, which is a concern.
Right.
But they've also consistently exceeded earnings expectations, and their revenue growth has been pretty solid.
Okay.
So the key question for investors is whether they can translate those top-line gains into sustainable profitability. It's like a sports team that scores a lot of points, but also gives up a lot of points.
Mm-hmm.
They need to tighten up their defense, in this case, their cost control,
Yeah.
to secure those wins, or in the business world, those profits.
Right. It's all about delivering value to shareholders in the long run. So we've reached the end of our deep dive into these three companies, Amkor, American Airlines, and CVS Health. We've explored their financials, their industries, the competitive landscapes, and the management teams. We've uncovered a lot of interesting information, some encouraging signs, and some potential red flags.
And remember, our goal wasn't to tell you which stocks to buy or sell. It was to equip you with the knowledge and the tools to make your own informed investment decisions.
Exactly. We've tried to highlight both the potential pitfalls and the potential opportunities, but ultimately the decision of whether or not to invest in any of these companies is up to you.
As you continue your research, I encourage you to pay close attention to how these companies adapt to the evolving landscape of their respective industries. Are they embracing innovation? Are they addressing their weaknesses? Are their management teams making the right strategic moves?
Those are the key questions that will determine their long-term success and ultimately your success as an investor.
So keep learning, keep exploring, and keep asking those tough questions.
Happy investing, everyone.